And then I just said to myself, I don't need investments. Let's bootstrap this or customer fund it. Let's just live within our means. And as we get customers, we'll grow. And it wasn't always easy. There were times where the revenue didn't come in quite as fast. And so payroll was being run on credit card or my home equity line on my house and all that kind of stuff that entrepreneurs do. But in the end, the virtue was that when we did sell the company, the employees and myself, we had the lion's share of equity. Founders are needy and we need validation, and we get validation when we sell our product because someone's using it. I know you're laughing because it's true, right?
No, it's true. Yeah, I mean, this is like the number one mistake founders make is underpricing their product.
Right, and people like you and I are like, no, you can price more. And they're like, oh, no one will buy it. And you're like, well, you can lower the price if no one buys it. But if someone buys it at such a low price, it's really hard to raise it.
Welcome to Seed to Sequoia, the podcast about go-to-market for early-stage technical founders. I'm your host, Alex Shartsis. As you know, we make these episodes for our subscribers. If you haven't subscribed, please do. You can subscribe on YouTube or any other podcast platform. Today's guest is Luke Hohmann. Luke recently wrote a new book, not his first, called Profit Streams. It's about how to price software. Luke is a repeat founder. He's built businesses. In fact, he built one, tried to get venture capital for it, failed, but succeeded with a huge life-changing exit. So we'll talk about that. We'll talk about entrepreneurship. We talk about how he sees companies that are built successfully and mistakes that people make. But mostly we talk about pricing. With that, let's get into it. Welcome, everybody. This is Alex Shartsis, and I'm excited to bring you a new episode of Seed to Sequoia. Today we have Luke Hohmann, who is a consultant, and I'm excited to have him on the show. Let's have him introduce himself.
Hi, everyone. My name is Luke Hohmann, and I am very happy to be here with Alex and you.
Well, let's start first just with giving people some background. You've written a bunch of books. You've done a bunch of interesting stuff. Can you give everybody just a real quick taste of like what you do now and how you got there?
Sure. I am one of the Silicon Valley dreaded serial entrepreneurs, which means I've started a couple of companies. I've had a couple of exits. I've also had one spectacular failure. And along the way, I learned a lot about product management, and I've written a few books, as Alex has mentioned. And the most recent book is Software Profit Streams, a guide to designing sustainably profitable businesses, where we're wrapping up our experiences as product managers and trying to provide a framework for the system of pricing that software-enabled solutions need to be successful.
This is, as everybody who knows me knows, is a super close to my heart subject because I think too many software companies, too many startups just don't get pricing right, and they don't even think about it and take it seriously. So I really want to talk about that. I think it's also really interesting. You bootstrap that company that you one of those exits was pretty much completely bootstrapped. So that's also, I think, something that is fun for people to hear about. Before we get into that, though, I'd love to. New question that I've been kicking around that I think is interesting is, tell me about a deal that you did. It could be your best deal, could be your worst deal, could be your best worst deal, but like just any deal that you did that like is a fun story.
Oh gosh, there's a lot. As you get older, you get the chance to do so many deals, and you get to also participate in deals. I think one of the fun deals I had was early in my career. I was asked by a VC to do a turnaround on one of the dot-bomb companies, and this was a long time ago. And it was the only deal I ever had in my life that I felt was a guaranteed win, because when I joined the company, the stock market had valued the company at $25 million, and it had $54 million in the bank. So they were being valued at less than half cash. And I thought, okay, there's no way we can screw this up, and we're all going to make some kind of a money on it, because the intention was to sell the company and as part of the turnaround. And it worked out. So that was a deal that was fun. Of course, selling my own bootstrap company was a great deal, and by far and away the best deal I ever had. And what was really fun about that, Alex, and you'll appreciate this because if you've had your own experiences with buying and selling companies, is that when the acquirer asked me, what would you sell the company for? And I said X. And the he paused for a moment and he said, wow, that's a really fair number. I said, yeah, I know how to value companies and I know X is completely fair. I said, why are you saying that? Like, you've worked with me before. We knew each other. And he said, well, I know you know how to do this. He said, but it's your own company and people tend to get emotional and, all the things about irrational behavior when it's your own product or service. And I said, yeah, I get that, but I'm trying to actually be consciously rational. And he just said, that's a totally fair valuation. And what was really cool is the number never changed. And it takes a few months to negotiate the deal and go through the term sheets and do all the reviews. The deal number never changed. And the deal terms never changed. Like, we had a handshake in one dinner and everything from there was stable. We just had to get through the process.
That's not for anybody who hasn't done this. That's not typical. I'm curious, why do you think that was? Like, was it? I mean, you mentioned having a relationship. Was it that? Was it how you conducted it? Like, what went in? Why? Like, how did you do that?
I think relationships aside, the acquirer was the company Scaled Agile, and the gentleman that I'm referring to is Dean Leffingwell. And Dean is an extremely experienced and extremely successful serial entrepreneur in his own right. And I think he just knew when I gave him the number that it was fair based on the business fundamentals. It was just, that's a fair number. Could I have gotten a little bit more? I don't know, maybe. Could he have paid a little less? Maybe. But was it worth it to us when we both wanted to do a deal? Both parties wanted to do a deal. And it's kind of like hiring. When you want to hire someone, there's kind of a band that you're willing to pay them. It's not a single number, right? Most hiring managers have a band. And if the requested salary of the potential employee is in the band, why negotiate a lot? You've got a band and they've requested a salary within the band, move on. Because if they're requesting it, then they would be happy with it, presumably. Right. So I was happy with the number. Could I have gotten more? I don't know, maybe.
Yeah, no, I mean, but also it sounds like you're dealing with the CEO founder, which yes. I think is a key part of it, right? Because there's no other approvals that are required. And, if somebody in the finance department got antsy about it and thought they could maybe get a good deal, he can just tell them to sit down and shut up and deal with it. Whereas if you went in through some other channel, it might have been harder.
I think you're right. I think that he wasn't the CEO anymore, but he was the founder. And the company itself was owned by a private equity firm. So there was probably some latitude behind the scenes to do the acquisition. And the structure was designed to be smooth, if you would. And so I appreciate what you're saying. I think you're right. And it might be, the company was, in the grand scheme of things, a moderately sized company. If it was a really huge company, like you said, there might be a deal department, and their job is like a buyer to go extract a better deal. But in this case, it wasn't the situation.
Yeah. No, well, so we skipped to the end, selling the company, and missed the build, all the work that went into that. But while we're still here, talk a little bit about having bootstrapped it, right? Like, when you get to the end, how does that change that process?
Yeah. When I started the company in 2000, the timing here is 2010 to 2019. So I founded the company in 2010, and I thought for sure I would do it the way you do it theoretically in Silicon Valley. I had an idea, you'd get some seed funding, you'd build your MVP, you'd validate it, you'd see the growth, you'd get your next round. I didn't have any of that because the idea was at the time considered so novel. It was a collaboration platform, but it wasn't Zoom or something like that or WebEx. It was a different kind of collaboration platform. And so I went to VCs and they said, this isn't going to work. It was partly the name. I had written a book called Innovation Games, creating breakthrough products through collaborative play. So it was a platform that used the concept of a game, in this case, a serious game, to promote innovation. And it was validated with a lot of experience and a lot of customers. And the VCs were like, no one's not going to play games. And I'm like, they're playing games now. They're doing it in person. We're just going to put it online. And so the VC said, well, you won't get someone to buy it. And I really believed in it. So we used services to bootstrap the MVP. We got our first license. And of course, I went back to the VCs and I said, well, you got a license. You must be a good salesperson. I thought you wanted, CEOs who are good salespeople. And then
when they don't want to invest, they really don't want to invest. It doesn't matter what you do that they said you needed to do. They're just not going to invest.
They're just not going to invest. And that's, I think, a lesson I learned. And I needed to learn it through the School of Hard Knocks, but they just didn't want to invest, but they give you other reasons. So then I got the renewal from that first customer, got a few more customers, went back to VCs, did another round on Sand Hill Road, and they're like, no, we don't want to invest. I'm like, okay, fine, don't. And then I just said to myself, I don't need investments. Let's bootstrap this or customer fund it. And let's just live within our means. And as we get customers, we'll grow. And we won't grow faster than we can because we're bootstrapping. And it wasn't always easy. There were times where the revenue didn't come in quite as fast. And so payroll was being run on credit card or my home equity line on my house and all that kind of stuff that entrepreneurs do. But in the end, the virtue was that when we did sell the company, the employees and myself, we had the lion's share of equity. There was one investor that was material, but that came when we didn't need investment anymore, and it was a strategic investment. And it was an investor who could really open doors for us and really help us. A guy named Vern Harnish, who's known in small companies for his method Scaling Up, or the book Mastering the Rockefeller Habits. So Vern was able to open doors. He was able to help us out. And was more of a strategic investor. But by the time Vern made his investment, we had kind of passed, quote unquote, the desire or the need for investments. And when we sold, the virtue is everyone made more money in their pockets. I have friends who've sold their companies for bigger numbers than what I sold mine, and I have a bigger bank account because of the way equity works.
Yeah, no, they don't. When you get on the VC train, you sometimes don't really fully understand what your destination is or what things are going to look like when you get to the destination.
And of course, I'm not opposed to VC funding. VCs are a source of capital, and we need them in our ecosystem, just like private equity or banks or your own home loan, right? These are all sources of capital. So I'm kind of unemotional about the source of capital. To your point, and what people who are new to this don't often realize is that every source of capital has its pros and cons. And you should evaluate the capital amount that you need, the restrictions, the obligations, and the benefits of that capital. And I am an LP in a VC fund. So, I support the community through, in a sense, that VC. So I'm not emotionally opposed to capital. Like I've seen founders like, oh, I'll never take VC, or I had a bad experience with VC. And in my prior companies that I hadn't founded, but I was working at as, say, the VP of engineering, those were VC backed. And by and large, I thought the VCs that had invested were really smart people who added a lot of value. So that means I don't always know how or why they make their investment choices, but it's not intrinsically a bad way to go. It's a different way to go.
Right. It's a different way to go. And I think that for high performing, like hyper growth companies, it's the only way to go, right? It's the only way to fuel that growth. I think when you get into the sort of mid-range or smaller outcomes, that's where you could easily end up with a much better outcome, just running it lean and owning all of it or most of it versus spending beyond your means and having to fund it through venture.
Yeah, I think you're right. And picking up on the term hypergrowth, sometimes hypergrowth is manifested by the need to buy more hardware or just make investments in my infrastructure to support my hypergrowth. Sometimes hypergrowth is associated with just acquiring the salespeople and opening up offices or doing other things. So I think you're right. I think when you look at the growth trajectory, and to be candid, the firm that I sold, it wasn't a hypergrowth firm. It was a B2B collaboration platform with B2B type sales. So we had a sales team, and then the deals were our economic model was very bottom up. How many sales reps do I have? How many deals can they close? They're not closing, a deal a week. They're closing a deal a quarter, right? The deals are big, and you're managing it a little differently. And you can only press that accelerator so fast in certain kinds of companies.
Right. Well, so let's talk about pricing, which is your main passion and what you're working on now. How did you come to be an expert in pricing in the first place?
A little bit of practical experience in working with some really smart people in Silicon Valley, a little bit of my own choices that you have to make as a founder about what your pricing is, and running numbers in spreadsheets. You can't do pricing, and you can't be a product manager, or you can't be a founder without really working a spreadsheet. And you can see the numbers, and there's no substitute for empowerment at a product manager level within a company and holding them accountable for creating a profit, because then they're really looking at those economic choices, like what do I charge, and learning how to model a spreadsheet. And then finally, a lot of books. There's actually a lot of wisdom in the world about pricing. Tom Nagel's The Strategy and Tactics of Pricing is considered one of the classics, and it is for a really good reason. It was one of the earlier books that talked about value-based pricing. However, what I found, and the reason we wrote our book, is those classics are text-heavy, they're very dense, and they cover a lot of things that have nothing to do with technology. And conversely, technology has a unique set of requirements, a unique set of forces that those older books don't contemplate, or those older books don't deal with very well. And so accordingly, we felt there was an opportunity to make a contribution with a new book and a new framework for software-enabled solutions. And our book, to be just candid, is I'm looking around my office and I see a picture frame and I see a water bottle and I see a glass case. Well, our book doesn't help you price those things. Tom Nagel's books or those older books might, but we're exclusively focused on software-enabled solutions. That could include hardware if it's got software embedded in it, like a microwave oven. But the world of software really is different than the old world of cardboard boxes or gaskets in cars.
Well, so let's talk about what makes it different. Why is software fundamentally different than those other things, the water bottles, the picture frame?
The most fundamental difference is that I don't sell you the software. I license your right to use it in some capacity. So I'm holding a pen right here. And if Alex and I were in the same room and I sold him this pen for a nickel, well, now I've transferred all rights to Alex. He could smash that pen with a hammer, and I can't do anything about it because he owns the pen. And he could write with the pen, or he could, put it underwater. Now, he might have some rights in terms of its fitness for purpose, or if it's a durable good, like if I sold him if I'm a manufacturer of a refrigerator and I sell him a refrigerator, well, I've got some responsibilities in the Uniform Commercial Code to provide things like spare parts for a decade because it's a durable good. But by and large, the most fundamental difference is that software is licensed, not sold. So there's a license agreement. There's, in SaaS terminology, that would be a terms of service. And there are restrictions about copying and using and reselling. And so there's all sorts of legal requirements. And software is a very heavily regulated industry. As an industry as a whole, we have restrictions on how data is acquired, how data is managed. We have compliance with various standards, in addition to industry standards. So for example, if I'm a payment processor, I'm going to have to be PCI compliant. That's not a law per se, but it's a set of standards that are so strong that you're not going to be able to go to market without PCI compliance. These are all things that go into making software such a unique thing, and that uniqueness has to be reflected in the pricing and go-to-market strategy, because I have to have a license agreement somewhere. I have to have something that governs that relationship between the person who is buying and using my software and the software itself.
Yeah, I mean, it's a great way to put it. software is different. There's a license. It's not a pen, right? It's something that everybody has obligations to, and you can take it away, right? Once the pen has left the store and you decide to smash it with a hammer, there's nothing the software company can do about it. But if you decide to smash my ERP software with a proverbial hammer, like, I can take it away from you. I can be like, yeah, you violated the license. You can't have it anymore. Talk to me about stage of company. Just let's start early and go late. Like, let's say I'm an early stage founder. One of my clients is dealing with this right now. 50 or 100 users, right? They're trying to figure things out. What advice would you give them as they price a B2B or a sort of single player version of their software? Like, what?
Sure. So we tend to think about the pricing and business modeling decisions in two broad categories. Before launch, where you're doing new product development, and then after launch, when you're associated with some kind of an S-shaped curve of adoption. And we know in Silicon Valley through Jeffrey Moore's work, almost everyone's aware of this notion of, well, there's the innovators who are the earliest of the early customers, the innovators are the visionaries. And then I have my early adopters, then my early majority, then my late majority, and then my laggard. So if this is a new company, then they're still working with those innovators. And this is where they should allow themselves the opportunity to do a little bit of business model and pricing experimentation. Things aren't really locked in place. Like, if you are further along the adoption curve and you're moving, say, from the early majority to the late majority, well, now you've got a lot of reference points. You've got a lot of reference customers. You've kind of got the grooves in the road established about how you want to go to market and how you want to price. But for those early, so those first few deals, you still have some choices that you can make around price points, et cetera. And as you know, part of a consultant's job in supporting an early stage company is convincing them that they have enough value to command an appropriate price. A lot of B2B companies will underprice their offering. Part of that is because founders are needy and we need validation, and we get validation when we sell our product because someone's using it. And so I know you're laughing because it's true, right?
No, it's true. Yeah, I mean, this is like the number one mistake founders make is underpricing their product. Like 99 times in 100, if your pricing is an issue, it's because it's too low, or at least early on.
Right. And people like you and I are like, no, you can price more. And they're like, oh, no one will buy it. And you're like, well, you can lower the price if no one buys it. But if someone buys it at such a low price, it's really hard to raise it. And depending on how you wrote your contract, your license agreement, your sale agreement, it could be locked in. I worked with a startup founder who was doing some very interesting work in AI and fraud detection for banks. And he's like, I was so excited. I closed my first deal and I wanted to get a 1-year license out of them. And they asked me for a 5-year license and I gave it to him. And I'm like, okay, wait a minute. Like, something doesn't sound like, what is your product doing? He's like, oh, it does this AI fraud detection thing. And it does this. And he goes, and I calculated that for this bank, it was in Australia, for this bank, it was going to save them something like $22 million. I said, well, what'd you charge for it? He said, oh, I wanted $25,000 for the first year, and they asked for $5,000. And I'm like, okay, you do realize that over a 5-year period, they spent $100,000 to presumably save nearly $100 million. I think you underpriced.
Yeah, no, I mean, like, there's so many times it's so typical, and I think what people don't realize is, like, if you had just reduced your odds of closing that client by 50%, but gotten 10 times more money. Right. Well, how different would your business look if that was a $250,000 a year times 5-year deal? Right. Like whatever he could have gotten, probably even more than $250,000. Like, yeah.
And this week, we've been teaching a bunch of startups from Riyadh, Saudi Arabia at an accelerator program, the basics of profit streams. And we were talking about a company that's still in the early stage. I mean, they're B2B, but they only have 30 customers. So it's early, 30, 40 customers. And he said, our pricing is doing great. We've won every deal. Like, to your point, I said, no, if you've won every single deal, that's absolutely a sure sign that your pricing is too low.
What are other signs? I mean, I think that's a great thread to pull on. Like, what are the other signs when you go in and talk to somebody that
that their pricing is too low?
Yeah.
Well, a sure sign your pricing is too low is if you haven't actually done an economic analysis of the benefits your product provides. And what I'm referring to right now is more associated with either expensive consumer products or B2B products. Now, inexpensive consumer products underpin a different set of physics because they might be fashion or they might be emotional or they might be cheap purchases.
Impulse.
Impulse, like an Apple Watch. That's still in the price point for most people, or you're wearing AirPods. AirPods aren't, you're not looking for kind of a rational economic assessment of the value of your AirPods. Right. However, if I were to walk up to you and say, hey, Alex, your house had some leaks and we need a new roof, or you're about to put in solar panels, you and your partner might say, we might like to have a little bit of an economic analysis because putting in solar panels is a pretty big spend. What's my payback, right?
Right.
And so a sure sign that a company is likely underpricing is if when you ask them, have you done an economic analysis from the buyer or the customer perspective of their economic benefit, and they don't have that, which is what we call a customer benefit analysis, it's certainly a sign that they're underpricing.
Yeah, I think there's two things in that. I think that the company needs to know what the benefit is. And if they don't know what the benefit is, they'll go save somebody $22 million and be happy with 25, right? I mean, that's what happens. And so that's an interesting insight. I think from a sales tactic standpoint, you still want the customer to do the analysis also, right? Like
yes.
If you just hand me here's your solar's going to pay back in 4 years, sign here. Consumers are a little different than businesses, but I'm not going to believe you, right? Whereas if I have to do the analysis myself and you give me the inputs or you let me go find the inputs somehow, I'm going to be much more committed to that analysis and be able to justify it, not just think, this is a sales guy trying to sell me some solar panels. Right.
Absolutely. And in our terminology, we call that a customer ROI model. And ROI models are out there and they associate often with B2B sales. And you can see those kind of ROI calculators on websites. So usually if a company has an ROI calculator, it's usually associated with better pricing practices. Conversely, if in the B2B space, if you don't have some kind of an ROI calculator, then it's also reflective that the company may not really know the details of how they provide value to someone. And I'm going to go on a minor sidekick on this one, just for a moment. B2B companies are often founded, not solely founded, but often founded by people with an engineering background. And engineers love efficiency in its various forms. And a lot of B2B companies will have some kind of a saving approach, right? I'm going to save you money by saving you time. But time is a relatively meaningless thing to save in most business contexts. I remember early in my career, we were working for Qualcomm in the trucking industry, and we were helping Qualcomm in the go-to-market and pricing of an offering that automated the driver's logbook. So drivers have to keep a log of their driving and they have to take breaks, et cetera. And we were able to demonstrate that our software saved 20 to 40 minutes a day of the driver's time. And when we took it to the customers, they're like, we don't care. And I said, why? Well, we pay our driver 8 hours a day union. So if you're saving me 20 minutes, I'm still paying the driver 8 hours.
Right.
So we had to go back and we had to help the companies that we were working with identify what would you do with 20 minutes. Well, you may not be able to reroute the truck and get an extra stop, but you can spend more time on problematic customers and make them happier. Okay, that can improve customer satisfaction and that can equate to revenue for the trucking company in the long run. If we're saving them more time, we can reroute the truck and get them an additional stop. And so what we try to do is we try to help people in their economic analysis get off of the cost reduction curve and get onto a revenue generation curve. Because if I can show you how my B2B software is helping you generate revenue, well, then I naturally want more of it. If I'm only focusing on the ability for software to reduce costs, eventually I'm going to asymptote on how much cost I can pull out of the system. And therefore I'm going to have a bottom lower bound on my value.
Yeah, I think that's a really interesting point. All of it, especially the engineer piece, because I pretty much exclusively work with engineers. They have this very rational way of justifying it, and like mathematically, it's right, but like it's not your customer doesn't care, and so it's like you can justify it however you want. And in the rare instance where people overprice, it's because they've like justified all this time savings and cost savings, and like there's just not something the customer cares about in the bundle of things they think they're doing for the customer. But I think one of the things that's also super interesting about that approach is that you're focused on like, when you're focused on cost savings, you forget that like they're fine, right? Most companies, especially if you're selling to like a couple $100 million company, an enterprise B2B product, right? You're a couple $100 million, 300 million, maybe family owned, maybe public, whatever. They're fine. They're in business. They get a salary. They're making a profit. So you could save them some money. Maybe I don't care, right? Like maybe I'm making it like
and what's it worth to me, man? If I've got to change my policies, if I got to change my procedures.
Yeah, if I don't get to play golf on Thursday because I got to be here chaperoning your stupid software project, like, no, I'm good. I'll go play golf and we'll keep making money. And like, yeah, we can, the best was when I was selling pricing software in like the bubble years of like the late teens, 20 teens. We talked to GetAround. I mean, GetAround was actually customer, but Turo, all these like, all the Ola Cab, all the Uber competitors. And they were like, yeah, we know we could do better at pricing and we think you guys could help us. But it's priced right now. We care about growth and it's priced into our fundraise anyway. Like everybody has just priced in this pricing improvement. So I'm not like, it doesn't, I don't get anything from it. Like I'm going to keep growing users and they're going to keep giving me money by the bucket, by the billion or, several $100 million increment and it'll be fine. And so I think that like savings approach versus, one of my favorite pitches was this company called Main Street, which is still around. They may have rebranded at some point, but they showed up and they were like, yeah, if you connect your payroll software to us, we will just get you the R&D tax credit that is otherwise a big pain in the butt to get. We'll just give you the money. We keep 20%, but we'll just give you the money. And I was like, where do I click? Like what, what, like why, like I'll just immediately do that. I just get money. I don't have to like learn anything. I don't have to do new tricks. Right. And so I think there's sort of different value props and when like getting free money, getting money is always easier.
Yeah, they switch the curve. And I think that's something that, and it's not always that hard to do if you have that mindset. And once we've coached entrepreneurs or we've worked with entrepreneurs and they start to develop that, I know I can save my customer some time. Well, now what do I do with it? That's interesting. So another example was, and it doesn't have to be even for products that go to market. It can be internal systems. We were working with DaVita Kidney Care, this really big company, and they do this great work with keeping people alive on dialysis. I mean, like this is a really great company. They're big, like $12 billion, and they've got dialysis clinics, and they're really important. And it was once again, if we put in these internal systems that we've built, we'll save some time for the managers of the clinic. I said, okay, but saving time for the managers of the clinic is going to get slurped up by just probably socializing with the patients, which is great. How do you reframe that so you could get another patient into the clinic? Or how do you reframe that so that the patient you're serving is served better so they'd have no complications, or they're changing their internal policies and procedures to improve the quality of the care given to the patient? And when you start to reframe it that way, they said, we could do this and this and this. And it's really just a simple point that time savings is not a super meaningful thing. And if you train yourself to look for what the time savings gives you, it's more important. It's kind of like going about salary, right? Money isn't money. Money represents something else for someone. Like I can take a vacation. Well, that's what money represents. Or I can spend more time, like you were saying, I can spend more time with my family records.
Or a measuring stick of success. So I'm more successful because I have more of it. But I mean, I think like understanding what the underlying thing is, it isn't just the salary. It's that like, this is a measure of my career, right? Oh, it needs to be higher for my next job, or I wasn't successful. I think is critical. I think the Main Street example, to go back to that for a second, they could have absolutely pitched time savings, right? Like, we'll save you 99% of the time it takes to get this free money from the government. And I wouldn't have bought it, right? Like, I think that like the way that they framed it, it was like, it's just free money for you. We will go get it, right? You don't even have to think about how much time we saved you, right? Because also it's like some of these things that are operational, like you don't want to think about the time you spend on stuff, right? It just highlights inefficiencies in your business. And, it's not a fun subject for some people, especially if they're really operationally focused.
You by the way, you just identified a pretty important psychological factor. That is, sometimes people don't want to be exposed for the efficiency that they could create. I once had a friend who they had a summer job as a substitute postal delivery worker, and they were young and in high school. So when they got the route, they were done, and the other workers in the office were like, "You don't have to go that fast."
Right. Yeah. Got jobs to protect around here. Well, so tell me more about the early stage, right? You talk like the big error is underpricing. The signs of that are either, you just talked about them, but the signs of that are really like, doesn't have a clear understanding of the value that the software created is the fundamental one. Wins every deal is another sign of it.
Is another one.
Are there? Go ahead.
Well, let's talk about the next big category of error is as the company gets a little bit of success, the next big mistake they make is they don't raise prices fast enough. They don't, what we call solution profitability management is as you're growing your software, presumably you're adding features, your quality is increasing. I mean, you and I have delivered software. I sometimes laugh at the software I built that I sold to my first customer versus the software that we had when we sold the company. Like, the user interfaces were vastly better. Like, we joke, like, remember the original version of Amazon? And, so your software is presumably getting better because you're getting feedback from your customers, you're making improvements. And so the second big error after those first two, and you're kind of going up the curve, is people don't raise their prices. They don't manage the profitability. And the third big error they make is they start with a single package solution and they stuff more value into that, more features, more capabilities. And it kind of gets bigger and bigger and bigger. And they're really happy, but then they get pushed back in a different way. People say, "Hey, could you lower my price because there's features in this software that I don't really need. And it's more complex than what we want." And what they're really saying is it's time to go through a repackaging exercise where initially we advocate that you start with a single package and you bring that to market and you get your early customers. But over time, sometimes you do need a good, better, best packaging. And sometimes you need a segment differentiated packaging. And where you start to look at, well, what are the needs of the different subsegments in the broader market that I started with? Because when people start pushing back, or they push back, wow, you got a lot of features, but you don't have the two that I need. Well, if you get enough customers saying, these are the two features that I need that the other people don't, who bought it and were happy, that's a signal that there's a segmentation challenge. And you can kind of classify these two errors under, I'm treating my offering as static and I'm treating my market as static, when your offering isn't static and your market isn't static. And you've got to adjust on both of those. So those are the next two big errors we see people make.
Yeah, it actually reminds me of a conversation I had with Phil Libin, the founder of Evernote, back in the early 2010s, where he basically, I think he's changed his tune on this. So, but I and maybe it was because of this conversation, but he was like, "Oh, we're just going to keep adding features to Evernote." And I was like, "I don't want more features in Evernote. Like, I'm like a passionate user of it. I pay the premium thing. I think eventually they gave me premium for free, but I was like, I don't want more features. Like, it's a lightweight app. I don't want it to turn into Microsoft Word. Like, it's here because it's a note-taking app." And he was like, "Well, if we add more features, people will just like it better." And I was like, "No, I will actually like it worse because it will be slower. It'll need to re-index. It'll need to do all this annoying stuff that, like, I just like it the way it is. Thanks. I'm willing to pay that, $5 a month. And, like, let's just leave it there." And I think engineers especially think, "Oh, more is better. Like, I'll add more features and that'll be better." And you go look at a race car and they like take the seats out. Like, there is no back seat. There is no, because like the feature they're promoting is lightweight and fast. And so you pay more for that Porsche GTS because it has less stuff, because it's lighter and it's faster. And so I think really understanding that segment, like what do people really want? Are these features actually adding value? Are they, driving support costs? Like, you don't realize that adding all these features are actually making it more expensive for you to provide the service, or making people feel bad because they're not using the software properly because there's 2 tabs they've never clicked on. Like, there's right. A trade-off there.
And I think you pulled out something really important in that, is that when we remove features, we can actually put our effort into the feature that people are using, and maybe we make that one feature, which seems good enough, just a teeny bit better. There's actually a study that was done not too long ago about customer satisfaction in Gen X for banking. And they're finding that some of the newer neobanks are actually winning because their software stack is a modern software stack. So if you want to like access one of the old banks on your phone,
right,
you're like sitting there waiting like 5 seconds for the
your .NET server does its thing.
Right, because they're taking an old COBOL program and they're layering on top of that an API, and then on top of the layered API.
There's Oracle in there somewhere. There's bunch of Oracle
in there, and you're like, and with the modern programs, the app just springs to life and away you go. And so the idea that I've got a simpler program, but now I've improved it and I've optimized it and I've made the feature that people want a killer feature, which we actually define a killer feature in our book. It's a feature that provides disproportionate value relative to the other features. And if you have a killer feature, it's fantastic. Not every product does, but it's funny. I used Evernote as an example of something that I think is another really big mistake that people make, and that is, and I'm controversial a little bit about this next statement, and I'm happy to be controversial, is we advocate for never using freemium, never offering freemium, never using freemium. A limited time trial is not freemium. Freemium is like, you can use the product effectively in perpetuity for free. Like Dropbox, I can use until I die if I'm under 2 gigs. Well, Dropbox has over 100 million free users, which is a significant cost to the company. So we didn't talk about this, but I would submit that any company that's using freemium is, in our opinion, making a mistake. And people will push back, "Oh, I need it for marketing." No, you don't. "Oh, I need it for trials." Well, no, you don't.
Yeah, let's double click on that, because I think there's definitely, there's a lot of freemium proponents out there. I don't know. You're the first person I've ever talked to that was like, no freemium. That said, like, I remember talking to Mark Gainey and Michael Horvath, the founders of Strava, very early, like pre-fundraise, where they're like, "Oh, we have this app and you got to like take your Garmin off your bike and plug it into your computer and get an adapter and do all this stuff." And 25% of people pay us after they do that 10 times because they want to keep doing it. And it's like, that's a pretty ridiculous conversion rate, for something that's a huge pain to do. I was one of the people that converted. But I think what was interesting was eventually I was like, but why are you not letting them give you data, right? At some point, like limiting people to 10 rides, like, is there a way to get their data? And, and I think what happened was, obviously Strava's been successful since then. Would they have been more commercially successful if they didn't have a freemium user base? It's a very interesting question. I think that you end up in this world where, now your conversion rate's not 25%, it's like 1% to 2%, right? And so unless you have a big enough user base and it costs you little enough to do that and you have some network effect value, then you're in trouble. I think one of the other things that's held Strava up on this freemium notion is that I don't think they have a killer feature for their premium, right? And so if you have that, like this, we ran into this at TripIt, where one of the killer features, TripIt was for people that aren't familiar, they would take all of your travel plans that came in an email confirmation and turn it into an itinerary, which was, it turns out, something nobody was willing to pay for. But one thing that was really valuable was putting those plans into your calendar in the right time zone, right? So your flight would be leaving San Francisco and arriving in Paris, and it would be actually in Paris time. You know, when you got to Paris and you open your phone, like the hotel reservation would be 3 p.m. Paris time, not 3 p.m. San Francisco time. And when your train reservation in Paris would be Paris time, so you could go from your flight to your train. And, time zones are hard. We never charged for that. And that was the most valuable feature. But it was part of the free bundle. And when we launched a paid plan, we were like, oh, we don't want to make that. We added new stuff for the paid plan. We never took the features and made them premium. And where I'm going with this is, like, a free trial isn't necessarily, like a freemium business can always go paid. You can take the pen away, right? Dropbox could one day be like, hey guys, we're sunsetting the freemium. If you want to keep using it, pay us $5. And of the 100 million users, maybe a few million would start paying the $5 and the rest would go away. I think that's sort of an interesting twist. Like Google Maps did this. They launched, it was free. You could use it. You can embed it in your app. This is probably for 5 or 10 years. You could just use Google Maps as a developer. And then one day Google came knocking and was like, hey, actually, like, you guys are doing like 20 million page views a month, Uber, and you need to pay for this now, right? And it was, there were always some things that were excluded, I assume for licensing reasons. But, even if you're doing freemium and you heard what Luke said and you're like, oh, maybe I'll stop. Like, you can stop. You can take the pen away.
Yeah, and we actually recommend that. Like, when we hit clients that are doing freemium, if the founders and the leadership team are open to it, we kind of go through the psychological counseling that you just did. Like, okay, let's really walk through this and let's run the numbers. And of course, people are always freaked out about pricing changes and price increases because, oh, what if I lose some of my customer base? Well, let's actually model that. What do you think the churn is going to be because of the price increase? Now let's test it. Let's actually do a little bit of market research. Maybe we do a Van Westendorp, or maybe we do a more sophisticated conjoint analysis. Maybe we do, we just do some split tests and we see what happens on the split tests or A/B testing. And we see what happens when people are actually presented with some different data. And we use those indicators to load up some financial models and make some choices. But Jason and I, my co-author, we are very comfortable in being controversial about freemium. And our standing position is we don't advocate for it.
No, I like it. I think one of the caveats I would put on it is when you're really early stage and you don't know what people are using, whether you call it freemium or free. Like, I think there is sort of a B2C world in which having users. We worked with a client that, was selling a B2C product, but only had like 20 people using it. Right. And you can't, and they were charging too much. They were one of the few companies they're like, oh, this is super valuable. Right. So we're going to charge $100 a month. And it's like, it's an iPad app. I don't care how valuable it is or what the alternatives are. Nobody's going to pay $100 a month for an iPad app. Like, it's just not a thing. And I think that at least in their market, and I think what was interesting was they just needed more people to use it because we didn't know what the killer features were. We didn't know how they found it because there wasn't anybody who had found it yet. Right. And so I think there are some circumstances where it's okay to do free, and free is like not free forever. Right. But in that context, it's like, oh,
well, it's not free forever by definition. It's some form of a trial or some form of limited use. I actually think it's interesting for everyone listening. You can tell Alex's experience in here because he's dropping so many gems and facts without highlighting them. So I'm going to pick up something Alex said that is a highlight. He said, and this is profound, and you acted like it wasn't. So I'm going to make it profound.
Right.
No one's going to pay $100 for a month for an iPad app. he's right, because what he's really invoking on pricing research is, and the pricing world of theory is what's called the concept of a reference price. Every product and service in your mind, in your use, you have a reference price, something that you think is near or associated with it that you're willing to pay for. You're not going to buy an Xbox cartridge or an Xbox or a Sony, video game for $5 and think it's going to be quality in terms of its play, even if it is. And you're not going to spend $999 on a Sony or Xbox game because it's just too far out of the reference price range. So the next thing that you have to do, and this one I don't think is among the huge errors that founders make, but founders should know the reference pricing that they're being associated with, but not use the reference price. Like the big error is, so-and-so charges $8 per user per month. I'm going to charge $650. No. That's not, it's good to know what they charge, but then using their pricing to set your pricing is a bad deal. But understanding what those range of prices are, those reference pricing, and saying, yeah, no one's going to pay $100 per month for an iPad app, but my app does provide that kind of value, and I'm going to charge for it in this other more clever business model monetization process. Sure. But that's a pretty profound thing that you just casually mentioned, was this reference pricing.
Yeah, I mean, that's what we did. We said, let's turn it into a program where you pay $500, right? And then you're getting your $100. It's a 5-month program, but like you get your $100, but you break out of this like app store expectation, right? And I think that's like, there's, if you talk to a pricing expert like Luke, there are also a lot of these things that have been really well researched. Like at Walmart, you're not going to find a lot of stuff for $250. Everything's going to be a little under $200 because nobody has ever spontaneously spent $250. But a lot of people have spontaneously bought AirPods for $175, right? Like if you keep under that $200 threshold, you can.
Similarly, if I was looking for a sweater and I went to Target, I have a price range in my mind already walking in the door, and I'm going to have a very different price range if I'm walking into Lord & Taylor or Neiman Marcus, right? And even the context. We actually talk about this. I don't think people talk about this enough. We talk about this in our book. We call it the provider context. And let's go back to the sweater. If I'm going to a mall and I walk into one store, it gives me a context. So when we look at pricing, we look at the context of how that web page, if it's a SaaS company, how are you presenting your prices? Like literally just how is that page laid out? And the layout of that page itself can affect how willing someone is to pay for the product or service, or the way in which you present your sales quote if you're B2B. That context of what you're framing the price in and how you're going to market is actually really important in and of itself, is understanding how am I communicating my value. In B2B, am I communicating it in some slapped together PowerPoint that, I once had a company that was pitching me. It was a consulting firm, and this was back at Contenio. And Contenio, I thought, maybe I can't get funding because I don't know how to work with VCs, and there's this company out there that says they can help, and they had good references and whatever. So I contacted them, and we did our interview, and they said, "Yeah, here's your proposal." I kid you not, 4 slides in, they had the prior company's name and the proposal they sent to me. And they called me up and they're like, "So you want to move forward?" I'm like, "Nope." Why? Well, if you're not going to take the time to write a proposal for me, right. I can't believe you're going to do a good job presenting me to a VC. "Oh, you don't understand. We have all the connections." I'm like, I don't understand. So no.
Well, there's something there. There's a lot there, because I think in the design world, which like we live in when we, work with people on their websites or their presentations or whatever, like people don't understand that, like if your titles on your slides are just moving around a few pixels every time you click to the next slide, or like the people, like they associate that with they're forgiving. Everybody's human, but like at some point, if you're a startup, you can maybe get away with it because, they're buying the founder's time. There's something else. By the time you're a Series B, Series C company, like it starts to be like, you guys don't have your stuff together over there. Like, I don't know if I trust you to do other stuff right because, the polish isn't here on the sales deck, right? If you can't get the sales deck right.
Eventually you need investments in that.
Well, it takes away from right, when you're selling on the value, if you come across as a used car salesman, you're going to get used car prices. If you come across as a Porsche, like go to a Porsche dealership, and even though the customers might be dressed in, khaki shorts and a t-shirt, like the salespeople are dressed nicely because you're at a Porsche dealership, right? You go to I don't want to pick on any other car brands, but you go to a used car lot, they're maybe not dressed as nicely. And so I think like that's part of what even though you don't consciously realize it, that's part of the experience you're buying. And when you talk to like the luxury car makers about the price points that they charge, about their experience, they're very conscious about what you talked about, that reference price. Like when you go into the Porsche dealer, you're not expecting to buy a $15,000 BYD car, right? You're expecting to spend a lot of money because you're in
That's
that
right.
reference environment, right? And when you go to a Ford dealer, I mean, I have a Ford, and when I called them to see if I could get the oil changed, they're like, "Why are you calling us? Go to any gas station. It's like $40, right?" Whereas when you have a German luxury car, you've got to go to the dealership, and it costs a lot more than $40. So it's that reference price that's playing in. I want to not change gears, but keep going on this sort of growth thing. Before we go sort of more upmarket or more sort of late stage with pricing and packaging, one of the things that I'm curious about is the confidence of the salespeople. Early on you talked about like, hey, you don't really know yet. You're experimenting. You may be split testing or whatever, right? Eventually you bring in a sales team because almost every business, even like Notion, has a 1,000-person sales team, right? At what point, like, does the confidence in your pricing model and your deck and your selling, the value you bring really impact the prices you can charge and get?
I think you, again, brought up something really powerful. And so let's go through the journey of that startup right up front. Every successful startup has an initial founder who could do a couple of sales, because if the founder themselves can't sell, and it doesn't matter if they're an engineer or not, even engineers, like I'm an engineer, my training, that's my background, that's my training. Even engineers can learn how to sell, because when it's an early stage startup and they believe in it and it's providing value, like you can make that pitch. But over time, I think you will benefit from salespeople. And now the question becomes, what is the confidence of those salespeople? One way to identify how confident your salespeople are is the degree to which they're asking for deal level discounts. And so we distinguish between price fencing and price discounts. So a fence is a different price for the same product or service that is applied to a group of customers that meet a common characteristic. So that's a lot of gobbledygook, but let me give you the example. A lot of companies will give the same product at a lower price to military veterans because it's part of their corporate value, or teachers. And so the fence is loosely defined as if you're logging into a SaaS, and let's just keep it SaaS because it's simple. If you're logging into a SaaS platform with a .org or a .edu email address, we think it's good enough. We'll give you the educational or nonprofit discount, because generally .edu and .org are, so that's a fence because it qualifies for everyone. Deal level discounts are when the salesperson comes into the CEO and in the negotiations or to the head of sales and says, hey, I got this deal and they're pushing back on price and I need a discount. So right there, you've got in general, in my opinion, right, generally you have a low confidence salesperson, because if you had a high confidence salesperson, they'd be pushing back and selling the value that exists. They know that price is fair. But if they don't think the price is fair and they get pushback, well, they're naturally going to ask for a discount. And so an important activity that you don't do early on, because you talked about getting up that growth curve, and I've got salespeople now, is every now and then you have to do a discount analysis. You have to take your sales that you've closed relative to your suggested selling price and do an analysis and see what the trend line gives you. Sometimes the trend line is a heartbeat, and it's a bad heartbeat. And in B2B, you'll see the sales price is good. In the last month of the quarter, it discounts. And then it's good, and it discounts, right? That's the classic Oracle, make the Oracle salesperson wait until the last day of the month and you get the last day of the month discount. So that is a bad pattern of discounting. And what you're looking for in the discount analysis is, A, are there any discernible patterns across your sales team, or are there discernible patterns for a given salesperson? And that if you have a given salesperson who's giving out more discounts than other people, then maybe they don't know the product well enough, maybe they're not confident, maybe they're just not good enough and you need to let that person go. But the discount analysis can give you some insight into the sales team's confidence in the price point and the deal structures that you're promoting.
So I'm hearing that there's like the individual performers, right? If I'm not very good at selling on value or don't build good rapport, whatever, like I'm going to be in the CEO's office asking for discounts all the time. There's also just in the aggregate, like, hey, if the whole sales team is doing this, maybe our pricing is a little off, or maybe we haven't trained them on selling value. But like, then it's more the company's fault. So looking at it in the aggregate gives you that, like, oh, hey, the market's shifted. Like you were saying before, it's not a static market. It's a dynamic market. We have a new competitor, maybe only in this one space. So we have to figure out how to address that. And if we've just happened to have been giving salespeople the ability to discount a bunch, but now we should address it with a fence or with some other approach.
With some other criteria. Yep, right. Absolutely.
Whereas, or like, hey, just Bob is always giving people half off because he's not very good at closing deals. And so like maybe we need to replace Bob. Yeah. I mean, I think that there's a lot to that, because especially at the early stage and as you make the transition to a professional sales team, founders get really needy and nervous about, like, is it me? Is it my company? Right? Are we not giving the salespeople are going to make excuses like every time if they don't close deals. And so, are they making excuses and we're thinking, oh, well, maybe I didn't give them a good enough sales deck, or maybe the landing pages aren't quite like, or the leads aren't good enough. And I think at some point doing an analysis is a great way to kind of get out of the weeds, shut off the excuses.
Right. And it's a different analysis, right? We know in sales we want to do win-loss analysis, and those losses and those wins have certain utility to the company. But a win analysis isn't always enough without a discount analysis. So, well, why did you win? Did you win because you discounted? In the old world, where we had more on-prem solutions, and we still have on-prem, right? It's not everything's in the cloud, but sometimes discount analysis provides insight into total cost of ownership, right? So let's say I've got some software and I want to put it on-prem. And to put it on-prem, I had to buy some hardware. I might have to license Oracle database. I might have to do whatever. Well, the customer is going to look at the value you provide, and they're going to lower the value by the amount of money that they are spending on their total cost of ownership to get your platform up and running. Or switching costs. Hey, I want to go from one payment provider to another payment provider, which could be better, but I've got to rewrite my APIs. I've got to rewrite my software. I've got to verify and test. I've got to deal with transitioning old data into new data. I might have to transition customer accounts. And early stage companies can sometimes forget that switching costs are part of what they have to absorb as they go up the growth curve. And it's not necessarily absorb in the sense of lowering your price, but you have to be aware that in the early stages of your company, you're dealing with those visionaries, and those visionaries are like, oh, new tech, new stuff, I'm good, I'll cover that switching cost. Those early majority and even late majority customers are like, hey, wait a minute, you're definitely offering a better product, but I'm going to have to change, and I don't like the change. And a change is costly, like you were talking about earlier. I'd rather be golfing. And so that is one of the things that can depress pricing because customers are discounting the value that you're providing by the amount of money they have to spend to get the benefit that you're providing.
Right. Which is, I mean, it's something that if you don't address, will just put the brakes on your sales. I think that the mentality of that early majority, one of the things I really like is companies that sell to entrepreneurs and other startups, because there are negatives, but one of the positives is there's no legacy stuff. So if you show up with a novel solution or if you have HR software, right, and you try and go to a Fortune 1000 company, like I'm pretty sure they have HR software already, and it's going to be pretty hard to rip it out and put in yours, and costly and everything, and it's probably pretty feature rich at this point. So like to build parity and do all the things that are table stakes is going to be a 5 to 10 year process where they're not sitting still. They're still building more stuff. I think when you go into a new startup that has, 2 guys and $5 million in the bank, like they'll try your thing, right? There's no switching cost. And so I think especially for software on, in more novel spaces, if you can, or even old spaces, if you can get a foothold in those early stage companies or, with entrepreneurs and founders, you skip the switching cost problem or you short circuit it. So it's like, oh, Luke he's the founder and he wants to use the thing. So I guess we're going to go switch. Right. And depending on the maturity of that management team, you might get people to not really look that hard at the switching costs. Whereas as soon as you get to larger, later stage enterprises, you have professional managers and their job is to calculate the switching costs and figure out how they're going to make it work in their ROI calculation. And you're not going to get past that. I think one of the things I've seen is like I have a couple clients and companies I've worked with over the years that sell into industry, manufacturing. And it is very hard just because you're selling to an engineer. Not only is there like cost associated, but you got to go train people. And there's that, golf is a great alternative to training your floor staff. Like it's a very hard sale. It doesn't matter what your ROI is. It's a very hard sale because, hey, we've been making this widget for 40 years and, and actually, one of the areas they've had success is like in EVs and electrification manufacturing because we just started making this thing. Right? Like we don't have a legacy here. So I think that switching cost is super interesting because.
And let's pull on that. So a smart startup will look at those switching costs and then if you can align your sale or your awareness of the sale when the customer is naturally engaged in something that would be switching cost anyway. And so let's go back to tease that out. Let's go back to that manufacturing example. One of our clients was Emerson Climate Technologies, and they had this, they're a really big company, so it's not a startup, but the principle still applies. They had some technology called the Intelligent Store, where they would put in sensors into supermarkets and help them manage energy spend. And supermarkets were like, okay, your solution is really cool, but my store is like 5 years old. I don't want to spend the money. So what their sales team started to do was they started to work with the store management team and say, okay, your Albertsons or your Kroger or your Safeway, you've got so many stores that you're going to be retrofitting some of them on a periodic basis, refreshing them. So tell us your refresh schedule and we will correlate the installation of our software when you're already making that investment. And they're like, oh yeah, that makes sense. So you have to know for these more sophisticated B2B offerings, if there's switching costs, that doesn't mean you have to take a frontal attack. You can kind of slide in and say, okay, I don't have to switch everyone at once. What's your cadence or what causes you to make a change? Oh, well, we make a change under these conditions. Great. How about we start there? And how about we work out when those conditions are going to change? Why don't we? Oh, your HR system is stable, but you're thinking of changing your financial 401k provider. Well, if you're going to make that change, how about considering our change? Right. Okay.
Yeah, I think that's, one of the things I talk about a lot is really focusing on the customer and their way of doing things. And sometimes you want to break the frame and, sell that sweater for $900 instead of, $19.99 at Target. But like, you need to do that with the understanding of how the customer works. And if you don't, and for large customers, like you're not gonna change the way they buy stuff. I don't care who you are. I mean, there was a funny story about, I forget the name of the company. It was a public company. Probably better I leave it out. A friend of mine was a VP of something there. And he was like, yeah, so we put our app in the App Store, and my lawyers printed out the terms of service from Apple and redlined it. And it took a couple weeks for me to explain to them that even though we're $100 billion public company, like Apple is not going to accept their red lines of its App Store terms. Like it's a take it or leave it thing. And, I think it's, at some point you just have to work. You have to figure out like, where are you, and work within the structure of how other people work.
Within that structure.
You can either like take Apple's iTunes terms, or you can not have an app in the App Store. Like those are your choices. You can't redline them. That's not a choice. So this has been really interesting. I want to make sure we hit on one thing that you and I talked about before we recorded around product managers and how they should think about pricing as they build the product, because that hasn't come up yet, and I feel like it's a really good point that you made in profit streams.
It's a really important point for me personally. The other area in which I am well known is in the Agile software development community. I've been associated with Agile software development in various forms since its founding, or since its inception way back in 2003. I helped even organize the first conference produced by the Agile Alliance in Salt Lake City. And then I've served on the board of the Agile Alliance, and I've taught people around the world Agile practices and product management. And what I started to see, and one of the reasons that motivated me to write the book, was that the Agile community, the product managers, they were so focused on this amorphous or ill-defined concept of value. So you go to places like Scrum, and you'll see, our highest priority is to deliver valuable, items on the backlog. And you're like, okay, I get that, and we want to deliver value, but can you put a number on it? As Beyonce said, put a ring on it. And so we are a specific area that we're focusing on as product managers, because something weird has happened in product management training and product management people. Is they no longer actually do pricing and licensing. It's done by different people or different parts of the organization. And so product managers are kind of losing their ability to set prices. I mean, when I moved to Silicon Valley in 1996 and I picked up my first product management responsibilities, I was responsible for pricing. And I remember the CEO at the startup saying, you're responsible for making sure that our company doesn't fail. I'm like, okay. He's like, I'm going to go raise money from the investors. My job is to get you money. Your job is to make sure that we can have you've got, at the time he said, you've got engineering and you've got product. You're VP of engineering and product. The sales team will sell because they got a good salesperson. The marketing team is going to get you and them leads because we got a good marketing person. But you better give me a good economic model. And of course,
I agree. It's really been lost. I worked with a mid-career product manager who was really quite good, but she just didn't have a sense for like, where are we making money? Where are we losing money? And some of the decisions around payments, it was like, no, we collect the money and then we give them the product. We don't, and it was like, well, is that a good user experience? And at some point I was like, I don't care. Like, we need to get paid. And so I think that, it was like, well, it was a weird exchange where I was like, well, are we focused on the same thing here? Like, I want us to be a going concern at one point. And they were coming at me with this sort of like, what's best for the user, like this sort of user-centric design stuff. And I was like, this isn't productive. Like, this isn't, we should be aligned on a viable business is like what we should all be trying to build here.
And for the product managers who are listening to this and rolling their eyes because you know how to do this, fantastic. You're with Alex and I. The issue is that there are too many product managers out there right now that are not with Alex and I. They don't know how to create a model. They don't know how to do a sensitivity analysis. One client of ours, they haven't raised prices in 4 years. I mean, inflation is higher in 4 years.
Right.
Even recently, we've had historically high inflation, but even still, 10 years ago, not raising prices in a SaaS company or not repackaging so I can have at least a higher price point for certain members of my market, that's unconscionable. And you start to see this loss of the economics. I mean, Alex and I are in the same boat. We're not independently wealthy for all space and time. Like, we make money for our families and we make money for our businesses. And you have to be sustainable means you have to make a profit.
Right. Yeah. I mean, all the time. I think it's very fun running a services business now versus a, $6.5 million venture-backed AI startup before, where like, you don't do things that you can't afford when you're bootstrapping or when you're running a services business. Whereas there's a bunch of stuff that maybe never produces ROI at a startup that you end up doing because other people do. Like it's a very different management style. And I wish I had this experience before I had that experience, because I think things would have been done very differently, right? You when you talk to multi-time founders, repeat founders who did the bootstrap thing and then raised money, like their style is just, there's a lot of growth in that have to make a profit to put food on the table kind of a mentality.
Right. I heard a great quote the other day, and I wish I could remember who said it. He said, first-time founders brag about market share, and second-time founders brag about profits.
Right. Yeah, 100%. 100%. So this has been amazing, Luke. I really appreciate you coming on. I have a couple of questions I wrap up every interview with, and the first one's always like, is there anything that we didn't talk about that you wanted to cover?
I would only submit that people need to be embracing the license agreement structures, the in licenses from your suppliers and the out licenses that you give your customers, because those determine a lot about your future profitability. What's the term? I mean, even simple things like, I'm going to do an annual license. Okay, well, great. Well, when does it actually start? Does it start, like you said, on payment? Or does it start upon installation? Does it start on first user? There's subtleties there that are important. But I think we had a nice contained episode.
Awesome. Yeah, no, I tend to agree. So the couple questions I have are not specific to pricing. Obviously, you can bring up pricing, but what are 3 best practices that you wish every founder would do? 3
best practices that I wished every founder...
I'm betting raising prices early on is probably...
Well, I would say the best practices, the first is actually quantifying the value you're providing. Like figure out from the customer's perspective, not your perspective, but the customer's perspective. That's absolutely a best practice. The second best practice is institutionalizing some form of consistent feedback in the company and making customer feedback and customer interaction part of your culture. Could it be interviews or data on your platform? But that you're driving blind if you're not getting customer feedback. And there's always a point where the founder has a vision, and then the vision transitions to the customer. And after you've launched, you're launching with your vision, and then there's this point where you're like, okay, my vision starts to become discounted, and I'll really listen to my customers and their needs. And maybe the other best practice is don't hire unless it hurts. And what I mean by that is, especially with people who have VC funds, they'll look at a little bit of pain and they're like, oh, we're going to solve that problem by hiring an employee. And what happens is the bloat occurs in startups because you took someone who was working a little bit hard and you hire someone to help them, but they don't really have a full-time job. They have like a half job that then you add in some junk. And so what happens is like a customer advisory board. Oh, it's really hard for someone to run the customer advisory board. Well, let's hire Frank or Sue. Sue is going to manage the customer advisory board. Well, you don't need a full-time person to manage the customer advisory board. So then you hire someone, and they're probably a fine person, but now you've got that little bit of bloat. You got that little bit of waste. And so my feeling is startups tend to hire a little too quickly, and then they tend to fire a little too slowly. So
yeah, you're not the first one to bring that up. I think I like the idea of like how you get there though, because I think people don't realize that like, oh, well, we'll find something else for Sue to do with the other half of her time. Like that's where the problems start. That's great. What's some good advice that you got? Could be the best advice, could be just okay advice, but And you don't have to have taken it too. You could have.
Well, the worst advice I ever got was I was working at one of my companies, and we had just signed a really huge deal. And I felt that, I mean, it was a really big deal. And it was a big enough deal that I could absolutely hire a full-time designer. And I felt that the designs that we had were from an outsourced design firm, and they were okay. I mean, they were fine. But I really wanted to bring in-house design. And one of my board of directors members, even though I didn't have VC funding, I believe that you should have advisors on the board. And one of my advisors said, don't do that. Just keep doing this. And I think it was the worst advice I ever had. And I think the best advice that I've acquired, I've given to myself, because every company that I've started or sold, or every company that has failed, I go through a retrospective, like really what worked and what do I want to retain, and really what was the mistake I made that I want to just never do that again. And I limit it to 5. So, it's not arbitrary. It's like really thinking it through. And I think that in the modern world where we are right now, you have to have design integrated and part of the team, and a commitment to design as part of what your offering is. You have to have that. The days of ugly B2B software, ugly consumer software, they're long gone. So that to me would be the best advice is invest in, and make design as useful and as important as your product leader and your engineering leader.
Yeah, I think that's great advice. Well, so thank you so much. Where can people find you, and where can people find your book, Profit Streams?
You can find the book easily on Amazon. That's the only place it's available. And you can find, or actually we just started selling it at profit-streams.com. But you can find me on LinkedIn, Luke Hohmann. I am super easy to find. And then once you connect to me on LinkedIn, we can exchange emails and all that kind of stuff.
Great. Well, this was phenomenal. Thank you, Luke, for joining us. Our guest, Luke Hohmann, author of Profit Streams. A few thanks on the way out. Our audio engineer and video editor is James Fix. Ryan DaCosta works on the marketing side of production. The music was by The Great White Shark. I'm your host, Alex Shartsis. Thank you for listening.